tough life.
Yeah, thanks, Paul. Appreciate it.
I'd be glad.
So I think for everybody, I think a lot of what I'd like to focus on is going to happen kind of towards the end of this presentation, which is how you can use the stuff we're going to go over to help you with your business. And I think with 4 people, this is a really nice sized group to kind of get into some more details on how to potentially build up business, find clients, and all of that good stuff, because that's always the biggest obstacle usually, right, is finding new clients. So this is just a quick overview of what we're going to cover. Do some introductions, what are these loans, how do you kind of differentiate them from other loan products, how can you use them, and where can you find some potential clients, some potential buyers. So if we can, let's introduce ourselves. So I'm Amir Razi. I'm president of OHN Home Loans. OHN is the in-house mortgage lender for Equity Colorado, so for you guys. We have been open now just a little bit over 3 months and have some nice closings under our belt. And I hope we can do some more non-QM closings, and that's what this class is going to cover. So we'll talk about that in some more detail here today, but can we start here?
Sure.
All right.
I'm Tammy. I think I met, I didn't meet you. What's your name?
Mitchell.
Mitchell. So Tammy Picert. And I have been with Equity for about a year now, and I'm here just to kind of learn everything you're offering, see some new information on these loans. So,
Okay.
yeah.
Did you have a specific reason, anything that kind of made you come to this class in particular? Or?
It did say for self-employed, which I
Okay.
do have a lot of people that I know that are self-employed, so
Okay.
I want to see kind of how that goes.
Perfect.
Yeah.
Okay.
Louis Chang. I've been with Equity probably 6-7 years, been in business for 10. I just recently had a closing where it was, the buyer was self-employed, and so just learning about statement loan. He did a statement loan.
And you said it closing, so it closed.
Yeah,
so
it did close. Yeah, exactly. So it went well, and so I just wanted to. In 10 years, it was the first time I've had someone that was self-employed.
Wow.
I purchased a house. Everybody's been either like conventional or FHA or something like that, or CHAFA, onto the CHAFAs and stuff. But this is the first one. So
first self-employed in 10 years. That's amazing.
Exactly.
That's,
So,
wow.
Isn't that's crazy.
Yeah,
Yeah.
When I reflected on it, I was like, yeah, this is my first one with this type of mortgage. So I wanted to learn more about what's available for buyers out there that are self-employed, because I do, like in my sphere, I do know quite a few entrepreneurs, there's business owners, and so be able to help them when they're ready to purchase.
Awesome. Okay, well, we're going to go into that. Tracy?
Tracy
Jot down a
Quintana.
couple notes here for you guys.
I've been with Equity since December of last year, so December of 18. And I just haven't had a lot of experience with this type of mortgage, so I wanted to learn about
Get
it.
some more information.
Mhm.
Okay.
Hi, I'm Mitchell Schaefer. I've been with Equity Colorado for about 6 days.
Oh,
Oh, wow, welcome.
So I'm trying to come to every Monday class that I
Brand
can
new.
right now.
Good
And,
idea.
And when I was taking my classes, they're like, hey, it's going to be a challenge if your client's self-employed, and that's all they touched on, so here I am.
Okay.
Very
So
good.
smart. Okay, so
Got a leg up on everything.
yeah, so based on that, I might take a little bit of a detour
Okay.
since we only have 4 people, and just give you guys maybe a little more background on what can be covered by kind of QM products, and we'll talk about what that means here in a second. And we can do a little bit more of a round table. Right, okay, perfect. So let's go over a couple kind of basic definitions here. So this class is about non-QM. Does anybody know what that stands for? So non-QM, oh, you're
Is
about
that
to say something.
Qualified mortgage?
Yeah, good. So non-qualified mortgage. Do you know what a qualified mortgage is?
It's backed up with tax statements, right? Or their
W-2s
credit
probably.
reports,
Yeah,
W-2s, employment.
you could say that that's true, but basically, what a qualified mortgage, just the simplest way to think about it, is years ago, mid to late 2000s. There was a huge market for subprime mortgages. Do you guys remember that? And then the housing recession, Dodd-Frank Act, all of that stuff happened. So the government started creating some rules. They also created the CFPB, the Consumer Finance Protection Bureau, to basically have more oversight over mortgages so that that doesn't happen again. And they created a set of rules. And the rules encompass a lot of different things, but basically they created a definition for what a qualified mortgage is. And it mostly revolves around the ability of a borrower, or let's just call them buyers for now, to repay their loan. So they have some debt ratio limits, there's kind of a limit on what you can charge them, just a bunch of different rules. And that falls into a definition of qualified mortgage. And lenders like qualified mortgages because there's certain legal protections that they get if they give somebody a qualified mortgage. So their chances of losing money on that loan are lower, right? If they need to foreclose, if the buyer defaults, things like that happen, they're a little more protected. So non-qualified mortgages fall outside of that box. Some people say that non-QM or non-qualified mortgage is kind of a euphemism for subprime. We're going to talk about those comparisons and why the products that are out today are different. But that's how some people talk about non-QM loans. So here today we're going to kind of use portfolio and non-QM interchangeably. Portfolio and non-QM aren't necessarily the same thing, but they're also not mutually exclusive. So portfolio can mean a lot of different things depending on the context that it's used in. So just for the purposes of today, when I say portfolio, I'm going to be talking about our portfolio products, some owns portfolio products. But portfolio products can vary quite a bit at every lender. Every lender's different. They might have their own portfolio products, but portfolio, in a nutshell, really just means that it's backed up by private money. Okay, that's kind of the simplest way to think about it. So if you go to like a First Bank and they do a portfolio product, they're usually the ones that are carrying that note. Does that make sense?
Yeah.
Okay. Agency versus non-agency. Anybody know an agency? What I mean by that? So agency is anything that's backed up by Ginnie Mae, Fannie Mae, or Freddie Mac. Okay, so this is typically, these terms are usually used to describe mortgage-backed securities or bonds, right?
Okay.
And how they're sold on the secondary market, right? So when somebody closes a loan, those loans get packaged up together into a mortgage-backed security that's sold on the secondary market. That's kind of how we get the liquidity that we have to give people a mortgage. It's a very simplistic way to look at it, but I think that's all you really need to know right now. Agency, those are loans that, or securities that are purchased or backed up by the government, basically, in one way or another. It could be through government-insured bonds or Fannie Mae, Freddie Mac, so on and so forth. Non-agency is anything that falls outside of that. Does anybody know the difference between conforming and conventional?
In terms of loans, I mean.
Yeah, just what that means. Is there a difference?
I don't think so. I wouldn't know though.
Okay. Conforming just basically means anything that falls under Fannie Mae and Freddie Mac guidelines. Okay, so those are, conforming can also be conventional. Conventional just means anything that's non-government. So that isn't FHA, VA, or USDA. So we're going to talk about this stuff a little bit more, but I just kind of wanted to give you a couple brief definitions here. Do you guys have any questions on those? So we are a one-stop shop. A lot of our focus today is going to be self-employed borrowers, but self-employed borrowers can also get conforming loans, right? Through Fannie Mae, through Freddie Mac, through FHA. One thing you should definitely write down, because this is typically the most limiting factor for a self-employed borrower, but almost any lender, whether it's a qualified mortgage, a non-qualified mortgage, conforming, non-conforming, whatever the case may be, they want to see a 2-year employment history. It doesn't always have to be with the same business, but that's typically the most limiting factor. Now there are ways to get around that, where sometimes you can go down to a year, but sometimes that can be really difficult. So just write down 2 years, and I will talk to you about some of those exceptions later on. But a lot of times with self-employed, we can just go straight down the fairway, so to speak, right? We can fit them into a Fannie Mae product, we can fit them into an FHA loan, a conventional loan, whatever. With your closing, you said you had to do a bank statement loan. Why did you guys have to do a bank statement loan?
Because they hadn't submitted or filed their tax statement for the previous year yet.
Okay.
And so I think because they hadn't done that, they didn't have enough years of tax. Is it 2 or 3 years of tax statements that you have to have filed? And so, I mean, they could have done it, but then there's a waiting period from the IRS to log it and things like that. So the bank statement loan just worked out better.
It just worked out
to get
better.
into the house,
Okay. Yeah, sometimes when you get into those details, it can depend a little bit. You don't always necessarily have to have 2 years. You're safest with 2 years. These non-QM products that we're going to talk about are changing very rapidly. So the guidelines are changing. The way they rate these bonds when they get sold on the secondary market, that stuff's changing. So there's a lot of rules that are constantly changing. It's always good to check. These program guidelines that I'm giving you now, these could be different a few months from now, so keep that in mind. So why does this all matter? We want to be able to close more deals and help more buyers, right? So I talked to you earlier about kind of comparing non-QM to subprime. Some people call this the new subprime. I don't particularly mind that nomenclature myself, but there are some big differences between what's happening now and what was happening before. And these are kind of some averages that we can kind of talk about. Oh, sorry about that. Use the pen here. So 2006 to 2019, vastly different markets, right? We have an entire new government agency that's keeping an eye on things. And if you look at the average credit score for these types of loans, it's significantly different. Proof of income is vastly different, right? Do you guys remember stated loans? Where people would just write down their income on a piece of notebook paper? No? Well, that was happening, right?
Wow.
Down payments, so somebody might just write down their income, they might get a 100% loan. I actually started in the subprime industry in 2003. So the types of loans that people would be able to get were pretty crazy. But I think the biggest thing that is different now is the layers of risk, right? So a non-QM loan right now, we still might be able to go down to a 500 credit score. We still might be able to potentially state their income, and there's a lot of caveats with this, especially if you look at the sheet that I gave you. But we're not going to be able to layer all of those things on top of each other like we used to do. And another big thing is there's a lot of oversight and regulation now that didn't exist before. So the landscape is completely different than it used to be, 12, 15, whatever years ago. So I don't necessarily agree with the term subprime because the way it was used back then is completely different. So that's why we're using non-QM, and also, to be frank, I think a lot of lenders are using it because subprime has some really bad connotations.
Yeah, negative connotations with it.
People think of that as a pretty bad word in the lending industry. So non-QM is what we say today. So a couple scenarios, and I want to hear about yours in a little more detail if you don't mind sharing. But we'll go through a couple today. So self-employed buyer makes $200K a year, credit score 758, but they write off everything. This particular person was a sole proprietor. They use a Schedule C, right, on their tax returns. There's certain items that people who use a Schedule C can add back into their income, but there's a lot of things that they can't. And self-employed people love to write off every possible thing that they can.
Yes, we do.
Maybe their shoelaces, maybe their CPA gives them an excuse to write off their automobile expense, whatever the case may be. And you guys are self-employed basically too, so you know this, especially if you filed your taxes recently. But every little thing you can write off lets you pay less taxes, right?
Yes.
But when you go to get a loan,
Looks like you.
it might
You
bite
don't make
you.
any
Might
money,
bite you in the butt, right?
Yeah.
You're not able to show the lender any income for a more traditional lending product. Now, do you guys file Schedule Cs? Are you guys filing as sole proprietors? Does anybody here have a corporation?
My husband has been self-employed for like 20 years. So
For 20 years.
Yeah.
Okay. Is he sole proprietor? Is he?
Yes.
He is. Okay.
Mhm.
So you're probably familiar with the Schedule C
Somewhat.
somewhat. Okay.
Love our tax guy, thank God. 'Cause like, I
Yeah.
don't
Can't
They're
do
worth
that.
every penny,
too
right?
much, yeah.
Yeah, so the most common things that can be added back for sole proprietors, for example, depreciation, that's something we can usually add back in. Business use of the home, so you guys probably work out of home quite a bit, if I had to guess. That's something you can add back, just as a couple examples. But in this scenario, right, they wrote everything off. They could only add back a small portion. So effectively, they're trying to qualify with $50,000. But looking at their bank statements, what they're actually transferring into their personal business account is a lot different, right? And that's something that we can use to qualify them. And I'm going to talk to you guys about how that works in a little more detail. Tax liens. IRS not clearing a tax lien, get a low FICO score. Now, there's other ways to handle low FICO scores besides a non-QM product, but sometimes the non-QM product might be the only thing that's available for other reasons. And in this particular scenario, it was. But that's another example, right? A low FICO score. Maybe there's a low FICO score and they're writing off a lot of expenses.
In this situation, I mean, with the underwriter receiving all the information on why, it's why the FICO score is low, because the IRS has taken their time on clearing the lien. I mean, is that possible for the underwriter to see that information and say, well, really your FICO score is actually higher, but because of this, the IRS is dragging their feet or whatever, we can approve. They have, I guess it's
Kind of, yeah. They're not going
lender
to
to
say
lender,
they're not going to say
yeah.
your score is necessarily higher. They're still going to use that lower credit score. But the thing is that they can't actually use that lower credit score. And not care as much.
not be as concerned, right,
Yeah.
about the lower score, the reason why it's a lower score.
Exactly. And the same thing's true with foreclosures, right? So recent credit events like foreclosures, bankruptcies. So if you guys look at the sheet here that I handed out to you, each of these products, we have different guidelines for seasoning. So if you guys go to the bottom left, like the non-prime program, you can see that we can do 1 day out, foreclosure, bankruptcy, other types of delinquent events like that. Now, one common denominator on these loan programs, and this is, I think, important, if you start to run into buyers that you know have already been denied, and you want to have an idea of whether or not they're going to qualify, is all of these programs require a down payment of some sort, right? So if you are the type of agent who gets into those types of discussions with your buyers, which obviously not all agents do, but if you are the type of agent that kind of talks a little bit and you're a little more open about their income and assets, find out if they have money for a down payment and where that's coming from, because that's one of the most important criteria. Now, you guys don't have to do that, right? A lot of agents aren't comfortable talking about finances with their buyers, and in that case, you can just send them to us, and we'll find that out for you. We'll do all the dirty work. We will very comfortably discuss that financial situation with them. But that's an important distinction with non-QM today and what subprime was in the past. And it's really important because that is one of the most important common denominators across all of these products. If somebody has a down payment somewhere around 5 to 10%, their chances of qualifying for a loan product go up significantly.
What's the minimum down payment then?
So they're all a little different, right? If you
Right.
go to the top left corner, for these types of programs, we have a program with a 5% down.
It's 5.
Yeah.
So 5 for any of these non-QMs are going to be 5% basically.
Well, so
Yeah.
5, 10, excuse
5
me,
to 10.
5, 10, 20. So if you look at the top line of each product, it gives you their down payment. So where it says 95% LTV, LTV is just the loan to value.
Right. Oh, gotcha.
95% LTV just means 5% down payment. 90% LTV means 10%, and so forth.
My brain neurons just connected.
No worries, no worries.
Thank you.
Sometimes I've been doing this a long time, so sometimes I forget that people don't know what LTV is. I take that for granted, so I apologize.
No, I should have known that.
If I just start rumbling a bunch of jargon. But yeah, LTV is loan to value. That's the loan amount to the appraised value or sales price, whichever's lower. So investors, if you guys have any investors that leverage financing, buy a house, get a tenant, or whatever the case may be, leverage their financing to then buy something else. Maybe they do fix and flips, who knows what the case is. Leverage that financing and keep buying and keep leveraging financing. Well, agency or conforming or whatever you guys want to, whichever terms you want to use, there's different limits on how many financed properties they can have. And so investors run into these issues all the time where they've reached a limit, right? But maybe they want to buy again and they want to finance it, especially with the way rates are now. At a certain point, they're going to hit those different levels of the number of financed properties, whether it's 4 or 7. Maybe they've done them all with one specific lender, and that lender won't let them finance any more properties. So these are really nice products for investors who run into that specific type of obstacle. So kind of a quick summary, right? Self-employed borrowers with significant write-offs, credit score issues, recent credit events, buyers with significant assets, and I'm going to talk to you guys about our asset depletion program, and then of course the investors. So let's go ahead and actually, before we go there here, so let's talk about these products a little bit. And Lewis, I wanted you to maybe share a little bit more about your buyer, if you're okay doing that.
I'll share as much
As much as
information
you
as I
know.
have, yeah, as much as I know, because you're right. I mean, when it comes to loans, some buyers are, willing to tell you everything, but when you talk to the lenders, like, well, that's between the lender and the buyer, right? So, if they want to share information from you, this is my experience with lenders before, is like, well, you need to talk to the buyer, and so because it is their personal information. As a realtor, I mean, it's great to have as much information as you can, but sometimes, it's like on the loans, like depending on the client, it's like I don't even know what their interest rate is, so,
Yeah.
But I'll provide as much information as I can. So.
Yeah, so do you have an idea of what their credit was like?
So their credit was good. It was up in
Good.
the 700s.
Okay.
And so probably between 750 and 8.
Okay.
And so their credit was good, but their thing was the write-offs, I believe,
Okay.
because so they were, I mean, paper-wise, they're writing off a lot, and so not a lot of income. And at this point, he was also growing his roofing company business. And so 3 years ago, I mean, they were making a lot less than they were the previous 2 years, or these most current 2 years. And so detail-wise, I think that's why they ended up with a settlement with a statement loan, just because their bank statements showed this lot of income coming
deposits.
in. Yeah, exactly. And so, and they hadn't had, and they were going to go, so they kind of had a hiccup. So the original lender that they went with was doing a statement loan. Then, like 4 days before the closing, all of a sudden they wanted IRS statements, tax filings, and we're like, from the very get-go, we're statement loans, and why are you asking for these now? It's like,
Yeah.
and this lending company has been known recently, as I talk to other lenders and stuff, trying to put out that fire. They've been known to switch at the very end.
Oh, interesting.
Yeah.
But they ended up not.
So they ended up going with a different lender.
Oh, they had to switch
Yeah,
lenders.
they had to switch
oh,
lenders.
Geez Louise.
Yeah, 'cause-
even though they said they were using a bank statement.
Yeah,
so-
because
Okay.
they were the lender was adamant about getting tax statements. And
Sounds
so,
like a lot of fun.
Yeah, 4 days before is like, I think you knew what you were going to do.
Right.
What you were going to end up doing 2 weeks ago, probably. Or you so they ended up with another lender that did give them a statement only loan,
Okay.
and that closed. I mean, they were able to do it miraculously in like 9 days. So
Gotcha.
it was actually, we had to extend the closing a little bit, but they got it done. So.
Yeah, so quick note on how to avoid that happening to you. And one of the very last slides I have is my recommended workflow if you guys decide to work with us. But to avoid those situations, the real key is to try to get your buyers in to us as early as possible. If you can send somebody to us before you even start looking at houses, which is really what you should be doing anyway. We can have an underwriter go through everything and collect those documents, take an application, get an underwriter to look at it, get verification that income, assets, all of that stuff is okay from an underwriter in writing before you even go look at houses.
So it's
And then
just
at
not
that point,
automated.
what's that?
You're not just doing an automated pre-approval then.
Yeah, so automated can mean a few things depending on who you ask.
Okay.
Typically automated, when we use that word, we're talking about AUS. AUS is just automated underwriting system. So that's just kind of plugging in numbers, sending it off and getting it approved through Fannie Mae or Freddie Mac or FHA or whatever the case may be. But it is automated. So the information coming out of it is only as good as the information you put into it. In addition to that, even if the information going in is good, the devil's always in the details. So if an underwriter looks at that information and sees something they're not sure about, you might have an issue. So it's always good to have an underwriter look before you submit an offer.
So you're saying you actually have an underwriter?
Yeah, so we do that. That's what I recommend
Yeah.
for you to do, because you're also spending a lot of time if you're going to show people houses before you know how well qualified they are, right? That's a big time investment that you you're kind of risking your time a little bit because you don't know how well qualified they really are. So we are going to talk about that here a little bit, but
So that's a pre-approval, not a pre-qualification that you're talking about, right?
well, I'm talking about a pre-approval with underwriter review. Okay. So we have 3 tiers of approvals, and when we issue our approval letters, there's 3 different tiers. We have a pre-qualified buyer. So that is what?
They've stated their income and
Yeah, they told us it's
and what their debts
verbal
are. Yeah, it's verbal basically. Yeah.
income assets. We check their credit, right? So we know their credit's probably okay. But that's kind of all we
Just
know. We
on the
kind of take
surface,
their
yeah.
word
Yeah.
for the rest of it. And then pre-approval is kind of the,
You've seen statements, tax statements.
yeah, so we've looked at stuff, right? But pre-approvals can fall short in certain areas, right? Maybe they've given us their bank statements and we've looked at the balance. And I don't want to say we, because we don't just look at the balance. We look at a lot of other things.
And it's funny how they forget like their foreclosure or that they had or bankruptcy that they
Yeah,
had 4 or
so,
5 years ago. So
Yeah, so pre-approval might be looking at a pay stub, maybe W-2. Maybe we're looking at a bank statement, or maybe a lender's looking at a bank statement, but maybe they don't scrub the bank statement. Maybe they bounced a check. That can cause a problem, right? A non-sufficient fund can cause an issue during the underwriting process. Maybe delay closing. Whoop. Sorry about that. Just hit that slide. So there's a lot more to it. So we like to get those documents in, have an underwriter look at anything that we're concerned about, and then sign off on it, because there's rarely a circumstance where it's a perfect buyer and everything's just totally straightforward and clean. There's always usually something that needs to get approved, whether it's income, assets, maybe the property is a little strange, who knows. So it's always good to get it in early. So our highest pre-approval letter is pre-approved with underwriting review.
So is that, some lenders will say, oh, all we need is a contract now on the house. You know, everything else has been checked and everything.
Mhm.
Is that kind of equivalent of that pre-approval with
Could be.
underwriting?
Every lender's different,
Right.
right? Some lenders say that, but
Their level of.
it's just a loan officer looking at it,
Investigation
or maybe it's a
is different.
processor looking at it. We have an actual underwriter look at it, and that underwriter basically gives us all of the conditions that we need for the loan. And so at that point, we're just focused on the property and whether their debt ratio works for that specific property, right? And every property is a little different
Yeah.
because of taxes, insurance, homeowners association, stuff like that.
I had heard that the pre-approvals were only good for 90 days. Is that across the board with lenders, or is that specific lenders? Like if you don't find a house.
I would say that's not going to be the case with everybody.
Okay.
A lot of times that may only be how good their credit report is good for. That's kind of a standard for credit reports. Could be 90 days, it could be 120 days. Every lender is going to be a little bit different. I don't issue pre-approval letters for that period of time because there's just so many things that can change. If somebody applies with us, we'll let them use their credit report for that period of time, but we won't issue a pre-approval letter for that length of time because there's a lot that can happen. They could go buy a car, they could open a Banana Republic card, maybe they go to Saks and spend a lot of money and it messes things up. There's just too many variables. I don't think that's a good practice to have a pre-approval letter that's good for that long.
Okay, so you're talking about once you find a house then?
Yeah, so the way what we would do, ideally send us that buyer. We do everything we can to make them feel comfortable, explain the situation, get their documents in, take a very thorough application. Any problem areas or areas of concern, we will get those signed off by an underwriter. That process, depending on the type of loan program, could be same day, or it could be up to 2 days. These types of loans, these non-QM loans, can take a little bit longer because typically the situation's a little more complex. But if you're not even looking at houses yet, that's when you have the luxury of time, right? And that's the time to do this heavy lifting, and then the loan process is a lot smoother.
So if they don't find a house, then, because I had
So if they
written,
don't
should
find
we
a
send
house,
buyers to
yep, great question.
lenders prior
Really
to
good
looking at
question.
homes?
Really good question. So if they don't find a house, right, you guys are struggling, or maybe you're placing some offers that you get beat out on. A lot of different possibilities there. But if they don't find a house, maybe your offers aren't getting accepted, whatever the case. So when we start pre-qualifying, pre-approving with underwriter review, so on and so forth, as they move up that ladder, we keep in touch with them. So if it's somebody who has income issues, we put them on a drip campaign to remind them not to do certain things and to do other things, right? Maybe they're credit impaired. But we want to keep reminding them that they're trying to buy a house. And so we kind of help keep them in that box that we qualified them for. So we can still use our credit report up to 90 days, but we're not going to issue a pre-approval letter for that length of time, if that makes sense. So what the process is at that point is you guys look, we are reminding them of whatever they need to be reminded of to stay within the box. And then as you guys shop for houses, you notify us. That could be through text, email. I would say the most popular way is text. I get a few texts every weekend with different addresses. And I will go in, look at taxes, insurance, and HOA dues, and let somebody know quickly if they qualify. Because then we have a very strong pre-approval letter that we can issue to that seller.
So you're issuing that after they find the house?
The pre-approval letter.
Well,
That's where I was getting confused, because I thought we're sending them to lenders prior to looking at homes.
so yeah, I apologize. I didn't. So you're sending them to us. I'm communicating with you and the buyer as to what you can qualify for.
Okay.
Right, and it's usually a soft.
So it's a pre-qualification
soft
letter,
number.
basically. It's not a
I'm not sending you
pre-approval.
guys a letter.
Oh, okay.
This is just communicated through email, text,
Okay.
whatever. Because the letter is going to be property specific. So I'm going to give you guys kind of a loose number. Maybe it's 500,000.
Okay.
And maybe there's a little leeway there, right? Because maybe they find something a little more, but taxes on that property are lower, so they can go a little higher. And then at that point, when you guys start to get close, you can do a couple different things. You can reach out to me and I can issue you the letter when you have a property that you like and you want to submit an offer on it. I can set you up in our lending portal, which means you can just log directly in. If you don't want to, if you don't like talking to me, you can just log in online and you can issue the letter yourself within certain parameters.
Okay, that's where I was getting confused. I was like, well, if we're getting the pre-approval first before the
Yeah,
homes,
so I'm
I got it.
sorry. So I didn't make the
that's
distinction
okay.
between pre-approval and pre-approval letter.
Okay.
Right, so we're pre-approving them, but we're not
Verbal.
issuing a letter.
Okay.
Right? What we're doing is we're making sure that if this buyer comes in with a contract, that we're going to be good to go. We've already done all the heavy lifting on the loan, and we can quickly issue you a letter that you can use to create that offer
Okay.
and feel very confident about that, and then also communicate with the listing agent and make sure they're confident about the offer too. I'm trying to get you up that pecking order
Okay.
on the offers, right? So if they have 15 offers, maybe you're getting into the top 3, you know,
Right.
for consideration or whatever that is.
Thank you for the clarification.
Yeah, so sorry if I didn't
Oh, that's fine.
explain that, but hopefully makes sense. That makes sense to you guys?
Yeah.
Cool. So there's a lot of potential here, right, for these types of loans. And we're going to come back to some of that in a little bit, but few statistics here. Right now, roughly about half of American households have a credit score above 680, right? Now that you can still do FHA, you can do other types of loans below that credit score, but sometimes you can't do those loans with banks. Well, you can't do those loans with bank statements, for example, or if somebody is writing a bunch of stuff off. Maybe they have a 640 and they're writing stuff off. There's a lot of potential there. 42 million, that's the estimated number of self-employed borrowers in the United States by the end of this year, and that number's increasing very quickly. Unfortunately, a lot of people filing foreclosures. That has dropped significantly, but there's still people with those types of credit events that are looking for loans. Buyers who are rejected by a mortgage lender. If you guys look at the lower left-hand side of this slide, and this is coming from NAR, it's a little old, but it's it holds pretty much true even now. I think I looked at the 2018 statistics and they were very similar to this. But debt ratio is one of the leading causes, right? And so when you have a self-employed buyer who writes everything off and they can't do the loan, they're going to deny that person for debt ratio. They're just going to say you don't make enough money, even though they might. Credit score is obviously another big one. And that's a lot of people who now we're trying to fit back into this bucket of non-QM loans. If you guys want these slides, by the way, just email me and I can send this to you. So investors, recent credit events, self-employed, low credit scores, all of these people are people you can help. And if you have somebody, this is our recommended buyer flow. So let's go over this in a little more detail. So when you guys bring somebody in early, aside from saving your own time and saving them time, we can really help them in a lot of ways. So we can also help them if they're on the fence, right? Maybe you have somebody who's you've been kind of talking to, they've been thinking of buying a home, they're a little nervous. Usually those people are nervous because they don't understand the financing part of it. Maybe in this type of a scenario, they have been denied before, and they're just not comfortable talking to anybody because they think they'll be denied again. So my job is to help create some of that comfort in letting them apply and letting them know that there's very little risk applying again. Because we want to gain that certainty that they can buy a house. So what do? We take an application, find out their credit, we find out what documents we need to collect, right? Same thing we kind of talked about. And then we underwrite the file. And then we give them an approval, like we talked about earlier, not a letter yet, but the ability to create a letter. Or we give them guidance. If they're coming to us, we're not going to just tell them, sorry, we can't help you, go away. We're going to guide them and put them into a longer term pipeline. Not only for us, but also for you. And I told you about those drip campaigns. So we do some of those drip campaigns based on what they need help with. We also follow up with them with the phone call to find out how they're doing. And then you guys get an automated drip as well to let you know the progress of what's been happening. And some buyers are motivated and they really want to buy a house, and they'll listen to what we are telling them to do, and maybe in 3 months or 6 months or maybe a year, whatever the case, they may have the ability to buy. Some buyers, they just don't want to do anything, they don't really have their stuff together, and it is what it is. But you're increasing your chances of closing more deals, right? I think one of the biggest kind of bucket of missed opportunities are these people who we can't necessarily help right away, but are motivated and can be helped with a little bit of work. But a lot of times if they get turned down, they just kind of get lost. Maybe the agent's not good at keeping up with them, maybe they don't keep track of them, and then they just kind of get lost in the shuffle. Everybody's busy, right? You guys have your careers, maybe you have kids, maybe you have your household stuff, but we will help you keep track of those people, which is, in my opinion, incredibly valuable. And that's with everybody, whether it's non-QM, QM, whoever the case may be, we're going to help you keep track of that pipeline.
So for those that need to rebuild their credit, to get higher, whether to qualify for loan, do you have in-house resources to help them repair their credit? You guide them, or do you refer them to other?
Yeah, so we don't have in-house resources. I get about 1 or 2 calls a week from credit repair companies. There's a lot of credit repair agencies that give mortgage lenders kickbacks for sending clients. I am not really a believer in that. I will only typically recommend services that I've used myself, or that somebody's used and had good things to say. So if you are sending a buyer to me, and let's say it's credit repair, I'm not going to take a kickback from a credit repair agency. I will first reach out I'll first ask the buyer, have you ever used a credit repair resource? Some people say, yes, I have. If they have, how did it work? Well, it sucked, or it was great. Depending on their response, I might recommend something that I know has worked really well before, but I'll also reach out to you as the agent and with the buyer's permission, obviously, and just say, is there anybody that you really like? And bring you in and kind of have it as a team type thing, because that helps everybody be a little more sticky as that buyer is going along and doing these things, right? Sometimes buyers come in, they get their credit repaired, and they forget who their agent was. And you read on Facebook that they just bought a house, and you're like, wait, why did you? And that's because you didn't keep in touch with them, right? So anything I can do to help you keep in touch with them is going to help everybody. But I don't have any in-house resources for that. Yeah. Any other questions on that? Does that make sense?
Mm-hmm.
So let me go here really quickly. Okay, so let's talk about where you guys can find some of these people. But before I get into the slide, actually, let's save that for the end. So anybody you may have turned down, or not you have turned down, but has been turned down, maybe they were self-employed, they couldn't get a loan. Do you have a CRM where you keep track of those people? Do you have resources to look back on and think, okay, is there anybody that I know wanted to buy a house and couldn't, and maybe falls into the bucket of some of these loan programs? Retail loan officers. So these are like Bank of America, Chase, Wells Fargo, maybe credit unions, right? Their boxes are much more well defined. Those loan officers have lots of turndowns that they can't do. You guys are agents, and it's a lot easier for you to make friends with loan officers than with most people, and those are good resources to go out. It's very easy to cold call on a retail loan officer as a real estate agent, because they naturally want to have a relationship with you, right?
Okay.
You guys have a lot of leverage there because you have the idea and the premise that you might potentially reciprocate business to them, right? And whether you do or not is up to your discretion, but and you might already have some relationships like that. Does anybody have a relationship with like a good retail LO? Probably somebody.
Yeah, I have one.
Yeah. So reach out to them. Hey, do you have any self-employed people that you're not able to help? Do you have any of those buyers? What can we talk about? What can we do?
Okay.
Builders and developers. Anybody see an angle here?
I mean, most of the large builders have their own in-house lender.
They have their own in-house, right?
Yeah, so that's tough to. I mean, they're always going to try to steer the buyer into using their lender.
They are.
There's all these incentives and things like that.
Except if what?
Unless it's a non-GM loan.
Yeah, unless they can't help them
Right.
and they have inventory they're trying to sell, right?
I find, my experience, those lenders, for a reason, they tend to be able to almost provide a loan for any buyer.
A lot of times they can't.
Yeah,
Yeah.
because they just have that flexibility, they have that power right.
Some do.
So,
Some do, some don't.
right.
Right? Yeah, some can work magic,
Yeah.
right? Especially if it's like a brand new condo. And the builder really needs that lender to work around all those condo restrictions. But there's opportunities too, because some builders can't. They go strictly conforming. They go Fannie Mae, Freddie Mac, FHA. They're partnered with a lender who's very inside the box. So the things that I recommend typically looking at are, do they have inventory? How fast are they selling? Are there a lot of homes that are available, that are built out, that they just can't sell? That's a good time to go in and reach out and ask them, do you guys do non-QM loans? Does your in-house lender do non-QM? Do you have a resource for that? Let's talk. Accountants and CPAs, they're involved in everybody's financial business, so always a good resource. Financial planners fit into that category. Bankruptcy attorneys, and mom and pop shops, right? Mom and pop shops could be anything, any kind of small business. Those are the ones that are most likely to write off the most expenses, but have a lot of income coming in on their bank statements. Let's see how we're doing on time here. Okay, we're on the hour. What have you guys, has anybody here had any success finding buyers through a avenue like this or anything else that they'd like to share?
I'm just starting.
You're just starting, you're brand new.
6 days into it, come on, you don't have any leads?
I do have 2 strong leads, but that's pretty much it.
Well, that's good.
That's
great.
good.
Yeah.
A weekend, right?
Yeah. Actually,
Yeah.
one of them does have a pretty awful credit score, so this kind
Okay.
of helps out a lot.
Yeah.
Yeah.
So awful credit, not always going to be non-QM, right?
Yeah.
Maybe it's an FHA possibility.
Yeah.
The goal is always going to be to fit them into the best product possible, what's best for them.
Yeah.
But we can do all of those things, so we can tell you what's going to be the best fit.
Okay.
I've gotten leads from a financial planner friend of mine, so that's worked out pretty good.
Okay.
Actually sold her house, so and helped them purchase.
Do you mind sharing how you met the financial planner?
Actually through church. We went
Through
to the
church?
same-
Okay.
Yeah, I went to the same church, and so just built up a
Yeah.
relationship there.
Mhm.
So.
Yeah.
The worst ones
tough
get
to
from-
be meeting people at church.
Yeah,
I mean,
exactly. They kind of know. Like,
strong
that's-
community.
Yeah, exactly. So
Yeah.
So that's been good. And the worst leads are probably from divorce attorneys. So
Those can get nasty.
yeah.
Those
I mean,
can get ugly.
I've done a few, but yeah, they can be. It just depends on divorce. Some divorces are amicable, and others not so much, and that can be difficult.
Yeah. So you met the financial planner through church. What made you guys decide to go and take that into the business realm?
I believe she just had a really good experience with me,
Okay.
selling her own property, so she trusted me, so it was like, why not? And her clients trust her.
Yeah.
And just like any referrals in any business, I mean, you want to refer people that you can trust, because it ultimately reflects on you.
Right.
If they have a bad experience with a referral you gave them. And so, I mean, I didn't really ask for it. She just all of a sudden one day, like with the first referral, was like, hey, I'm going to send you a referral. I'm like, oh, very good. And with any referrals, I always thank them, for the referral, whether we close or whether it leads to anything or not. And so, yeah, I mean, I think that's been a great relationship. So.
And how does she know? Is it just purely based on I have somebody
So-
that's looking to buy, or
Well,
what's?
the 2 times have been, like her clients have been reviewing their financial plan, and then all of a sudden it's like, hey, I need to sell my house, you know, because I need to downsize, or we have this investment property that we just want to get rid of, or something like that. So, yeah, she finds out that they need to sell a property or even buy, and then she just gives them my name.
So, you can expand a little bit if you want with her, right?
Yeah, for sure.
On some of these events, right? Because she's going to know if somebody is going through foreclosure,
Right.
filing bankruptcy.
Yeah, it's like, hey, you know, even though your client can't do a conforming one or a QM, or, you know, there's other options for them, you know, because people are in different parts of their life, right? Sometimes good, sometimes bad situations. So, no, this
Yeah.
definitely helps.
Thank you for sharing that. Anybody else? Anything that might be helpful for the group? So this retail LO thing, I have had a friend who's really, this is in Texas, really successful, just going out and building relationships, and I think they did like half their business on the turndowns that they couldn't do, and we just partnered really well. They would kind of pull in that business, and then we would get them qualified, or at least pointed in the right direction on what to do. So I think that's a really interesting avenue. So let's talk a little bit about what we look at when we pull these loans in. And I'm going to focus mostly on this bank statement loan. And the way it works is essentially we are just taking their bank statements. And if it's personal bank statements, we're just taking 12 months. If it's business, we're taking 24 months. And we're really just looking at the deposits, and we're typically crediting them about 50% of whatever they're depositing into their bank account. Now again, the devil's in the details. If they have, you know, deposits every month of, let's say, $8,000 to $10,000 coming from one source, and then maybe one month they have a $150,000 deposit, may not be able to use that, right? And that's why it's important to get this documentation in, because we don't want to just look at it, add up a bunch of numbers, and say, okay, you can buy a house at this amount. We want an underwriter to look at it and tell us specifically which of those deposits are we going to actually count to get a really true, accurate number for their income. But we don't require tax returns. We don't require a 4506. You guys know what a 4506 is? 4506 is an IRS form that allows us to order their tax transcripts directly from the IRS. So next time you go to a closing, if it's Fannie Mae, FHA, probably most loans that you'll see at a closing, probably see your buyer signing a 4506. And you'll see it, you'll kind of notice because at the very top it says IRS on it. But it basically just allows the lender to order tax transcripts, because we want to make sure that the tax returns that are given to us are actually real.
Mm-hmm.
So have you ever had a situation where the ones they ordered were different than the ones that were submitted to them? I mean, the loan's already given. Can the lender retract the loan?
Yeah.
Well, they can. Because
yeah,
of that
they can.
defaults. Oh, okay.
Yeah.
Based on that.
Yeah, if there's fraud involved, yeah, they can
I guess
do
that makes sense.
whatever they want. But true situation of what actually happens afterwards is a lot more complicated. So I'll tell you that.
I mean, they don't, the lender just has the buyer sign that disclosure in case they need to.
In case they need to. They don't always order
Gotcha.
it, right?
That's what I was getting at. Do they always order it? Just
Do not
to
always
verify?
order it, right? A lot of times it just comes, a lot of times it's only ordered during an audit, right?
Gotcha.
Because as a lender, depending on the loan program and without making this explanation too complex, there's a certain percentage of loans that will go in an audit to make sure that things look good. Just make it sound simple with that phrase. In some situations we do order it, even during the loan process. So it just depends. Yeah.
So I noticed, like,
But for these bank statement loans, we're not collecting tax returns anyway,
right,
right?
yeah.
So we're not even,
So you're not.
there's no
even
need for
that
4506 because we're not doing anything anyway.
And I noticed you stated that, like, none of these loan products have a mortgage insurance.
Correct.
So, I mean, are you insuring the loan by taking a higher interest rate? Charging a little bit
Well, I
higher
wouldn't
interest
call it
rate?
insuring the loan.
It's not insuring, but.
Yeah, so there is no insurance, so to speak, right? The rates are higher on these products, right? Because they're riskier products, and anytime the risk increases on any loan, it becomes more expensive, right? The bigger the risk the lender takes, the more they're going to charge for that. But these rates are really not that crazy. So depending on the loan program,